Smith Micro's latest quarter was a real head-scratcher. You had revenue going down, but profits, they actually went up. So we're going to unpack exactly how they pulled that off, what it means for their big turnaround plan, and get right into the key numbers.
Okay, here's how we'll break it down. We'll start with that surprising earnings snapshot, then we'll dig into the numbers to see the story behind them. After that, we'll look at the company's huge pivot to its SafePath platform, see how Wall Street reacted, and wrap it all up with our take on what to watch for in the next call.
You know, the story of this quarter is a fascinating one. It's really a tale of two very different lines on the income statement. You've got the top line and the bottom line. And frankly, they're telling two completely different stories.
So on one hand, Smith Micro missed their revenue targets. Not great. But on the other hand, they delivered a huge beat on earnings per share. This immediately brings up the big question for the quarter. How in the world did they manage that? And what does it tell us about where the company's headed?
Let's look at the hard numbers. Revenue clocked in at $4.4 million, which missed what analysts were looking for and was down 14% from last year. But here's the kicker. The loss per share was only 14 cents. That just blew past expectations and was a 63% improvement. The two numbers that really tell this story are that massive jump in gross margin and that very low cash balance. We'll definitely come back to that cash number.
All right, so let's get into how they delivered that earnings beat, even with sales dropping. The whole story, I mean all of it, comes down to one thing: operational efficiency and a much, much healthier margin.
This number right here, this explains everything. A 480 basis point improvement in gross margin. That means for every single dollar in sales, the company is keeping almost 5 cents more than it did a year ago. Now that might not sound like a ton, but it was the single biggest driver behind the earnings beat that got investors so excited.
So how'd they do it? Well, it wasn't an accident. It came down to three key moves. First, some serious cost discipline and restructuring. Second, they made the strategic decision to sell off their lower margin ViewSpot business. And that move was brilliant because it not only streamlined the company, but it also naturally shifted their focus to their higher margin family safety products. This was a clear, deliberate, and so far, very effective plan.
In this move, this pivot really gets to the heart of the story. Smith Micro isn't just cutting costs to try and survive. It's completely reshaping itself to focus on what it believes is its future growth engine.
Let's walk through the timeline because it really shows a company on the move. On June 3rd, they sell ViewSpot. Less than a week later, they bring back a trusted executive to be both COO and CFO, really tightening up operations. Then in July, they go out and secure $1.5 million in financing. It's like they're building a bridge to their next phase of growth. These are all very decisive moves.
So what's the big prize they're after?
Well, according to the CEO, Bill Smith, it's all about this. He said the new AI-enabled SafePath 8 is already creating additional momentum in talks with mobile carriers. This is the product that their entire turnaround story is riding on.
Now, just for some quick context, the SafePath platform is Smith Micro's bread and butter. It's the software that carriers can offer to their customers for things like location tracking, content filtering, screen time management, all that stuff. The whole strategy is to get this tech embedded even deeper with the big carriers, especially with new custom operating systems for phones designed for kids and seniors. Okay, so we've got a revenue miss, but an earnings beat, all driven by this major strategic pivot. How did the market, which usually hates a revenue miss, react to all this? Well, it seems it placed a bet on the future.
This is the million-dollar question for any investor looking at this quarter, right? Why on earth would a stock rally when sales are actually declining? It's because the market wasn't looking at the past quarter. It was looking at the plan for the future. And the market's verdict was immediate. The stock popped over 6% in after-hours trading right after the earnings call. I mean, this wasn't a small reaction. It was a clear vote of confidence in this new, leaner strategy.
In fact, it wasn't just Wall Street taking notice. Interest from retail investors absolutely exploded. We saw message volume on platforms like StockTwits surge over 3,000%. The turnaround story clearly hit a nerve, and it flipped sentiment to extremely bullish almost overnight.
Now, to really understand that explosive reaction, you have to zoom out and look at the bigger picture. Over the past year, Smith Micro's stock had fallen almost 13%, while the rest of the software sector was soaring over 32%. Investors were losing patience. This quarter's margin improvement and that clear strategic pivot, well, it gave them the first real spark of hope they've had in a long, long time.
So let's put it all together.
What are the key things we're going to be watching for ahead of the next earnings call? What's the investment thesis from here?
Here are the 3 catalysts that absolutely must happen. First, the launch of SafePath 8 has to go off without a hitch and really wow the carriers. Second, they need to turn all these promising conversations into actual signed deals with new carriers in North America or Europe. And third, management promised it, so they have to deliver sequential revenue growth in the second half of this year. No excuses.
But, the risks here are just as clear as the opportunities. First and foremost is the balance sheet. With only $1.4 million in cash, liquidity is tight. That leaves basically zero room for error. Execution is also a huge risk. They have to deploy these new products perfectly. And finally, let's not forget the company is still incredibly dependent on just a few very large customers.
So, for the next call, our rating is market perform. Look, the strategic pivot is smart, and that margin improvement is absolutely real. But that razor-thin balance sheet and the high execution risk, you just can't ignore them. The company has bought itself some time and some investor goodwill. The question now is pretty simple. Can they turn this newfound discipline into actual top-line growth? It is all about execution.
This is not financial advice.